Hi. Let's learn about liquidity premium. Liquidity premium is the extra compensation offered to investors for putting their money in assets that cannot be easily converted into cash at fair market value. For example, long-term bonds usually carry a higher interest rate than short-term bonds due to their relative illiquidity, offering investors a higher return as compensation for the additional risk. Illiquid investments, such as certificates of deposit and certain loans, cannot be easily liquidated or withdrawn without a penalty. This lack of liquidity is considered a risk as it limits the ability to quickly convert an asset into cash without significantly affecting its price. Some examples of illiquid investments include certificates of deposit and certain loans, as well as assets with no active secondary market to realize their fair market value. The liquidity premium is one of the primary reasons why longer-term bonds offer higher interest rates. The shape of the yield curve, which shows the interest rates of bonds with different maturity dates, can be used to predict future changes to interest rates and market activity. A simple way to calculate liquidity premiums is to compare similar investments, with one being liquid and the other being illiquid. The difference in their yields represents the liquidity premium. The yield curve illustrates the liquidity premium demanded from investors for longer-term investments. Additionally, properties in different neighborhoods and investments in publicly traded versus privately held companies can also showcase liquidity premiums. A high liquidity premium means an asset cannot be easily sold for cash, and while it can offer a greater long-term return, giving up flexibility may not always be worth it. Finding the right balance between yield and liquidity is key. Here are 3 key takeaways. 1. Liquidity premium is the extra yield built into the returns on an asset if it cannot be cashed in easily or quickly. 2. Illiquidity is considered an investment risk since you can't sell the asset quickly if needed. It can also be an opportunity risk if better investments emerge while the money is tied up. 3. The more illiquid the investment, the greater the liquidity premium that's required. Hope this would help. Thanks for watching.